Welcome to this explainer. Have you ever wondered why it feels like the global business landscape is just completely dominated by a few massive giants, while new challengers seem to struggle more than ever just to keep the lights on? Well, today we are unpacking the hidden mechanics of this modern David versus Goliath battle. We're looking at a super powerful, but honestly often overlooked factor, corporate income tax. Because it turns out, the way a country designs its tax code doesn't just collect revenue, it literally shapes who gets to enter the market, who gets to grow, and who ultimately fails. To really wrap our heads around this, we're going to break it down into 6 stages. 1. Declining business dynamism. 2. Entry and compliance hurdles. 3. Financial frictions. 4. The tax incentive illusion. 5. The corporate tax gap. And finally, 6. What a truly comprehensive tax policy actually looks like. Let's get into it. Section 1. Declining business dynamism. Let's start by diagnosing the macro-level problem we're seeing in economies all over the world. Before we even talk about taxes, we really need to understand what we're actually losing right now. We're talking about business dynamism. Basically, think of this as the vital heartbeat of a healthy, competitive economy. It's this continuous, energetic process where new firms enter the market with fresh ideas. The successful ones expand, the obsolete ones exit, and jobs are constantly being created and moved around. Without this heartbeat, an economy just kind of stagnates. And the data behind this heartbeat is pretty startling. If you look at this chart from the OECD, you can see an undeniable long-term downward trend across multiple advanced economies over the last 2 decades. Startup entry rates, job reallocation rates, the share of employment in young firms, they're all just steadily dropping. We are simply not seeing that same vibrant churn of new businesses that we used to. Which brings us right to the big question. Why are startups slowly disappearing? Why is this well of entrepreneurship drying up? Now, obviously there are a lot of factors, but researchers are increasingly pointing a finger straight at the incredibly complex web of corporate income taxation. So let's look at how this actually plays out on the ground for a brand new entrepreneur. Section 2. Entry and compliance hurdles. This is all about the immediate, real-world roadblocks that new businesses smash into before they make even a single dollar of profit. Imagine you are starting a business. Before you even have a chance to worry about your product or your marketing or your competitors, you hit what we can call tax complexity toll gates. And the thing is, it's not just about the actual money you pay in taxes, it's the massive cost of just figuring out how to pay it. You're navigating multiple tax types, laws that are constantly changing, different administrations, wildly confusing legal interpretations, and strict deadlines. The OECD actually notes that these compliance costs act as a literal barrier to entry. Get this, evidence from Switzerland actually showed that just reducing the length of their tax code by 10% was linked to a 1.5% increase in new firm creation, just for making the rulebook shorter. And this right here perfectly illustrates that David versus Goliath reality. For a massive, established incumbent, extreme tax complexity is just another Tuesday. They absorb those costs without breaking a sweat because they have entire floors of in-house tax departments and specialists. But for a small startup, that relative burden is absolutely crushing. They have to drain their incredibly limited funds just to hire expensive external advisors, and honestly, they're highly exposed to the variable quality of that advice. The complexity itself literally becomes a competitive advantage for the giants. Section 3. Financial frictions and risk. Let's shift to the financial lifeblood of a young company and see how the tax system can either fuel it or totally choke it out. When you launch a startup, you are taking on a massive financial risk, right? And odds are you're going to lose money in your first few years. Well, tax systems actually recognize this through something called loss offset provisions. In theory, in a perfectly neutral system, this acts as a kind of insurance. It shifts a bit of that early entrepreneurial risk over to the government by letting businesses use those early financial losses to reduce their taxable income in the future. The whole goal is to encourage bold, innovative risk-taking. But, and this is a huge but, the crucial point is how asymmetrical this is in the real world. Think about an established giant. If they launch some risky new project and it completely tanks, they can immediately use those losses to offset the taxes on their other existing profitable operations. Instant relief. But a new entrant? They don't have any prior profits, so they're heavily penalized with delays because they can't actually claim that relief until they finally become profitable, if they ever do. So the tax code is basically inadvertently cushioning the giant's fall while letting the startup just hit the ground hard. Section 4. The tax incentive illusion. we really need to dissect why these policies that are genuinely meant to help businesses innovate actually end up backfiring. Okay, so governments love to offer tax incentives, right? Especially for research and development, R&D, to try and spur innovation. But look at who is actually claiming them. Large incumbents already have massive R&D budgets, so they efficiently scoop up the vast majority of these incentives, which of course just strengthens their dominant market position even more. Small firms, meanwhile, usually lack the initial capital to do large-scale R&D. And crucially, if those tax credits are non-refundable, they are completely useless to a young, loss-making startup. So this intended lifeline for the little guy, it ends up acting like a steroid for the big guy, raising those barriers to entry even higher. And that leads us to a truly fascinating, kind of backwards behavioral distortion. Sometimes governments see this problem and try to fix it by creating specific tax incentives only for small businesses. But research actually shows this can weaken business dynamism. Why? Because it encourages a phenomenon called bunching. Startups will actually intentionally stunt their own growth. They'll avoid hiring that next employee, or they'll pass on a big new contract just to make sure they stay below the eligibility threshold so they can keep their tax benefits. So the exact policy meant to help them grow actively incentivizes them to stay small. Crazy, right? Section 5. The corporate tax gap. Let's see how all of this, the compliance costs, the asymmetric risk, the skewed incentives, builds up to a massive gap in the taxes that are actually paid. To really understand this gap, we have to look past the statutory tax rate. That's just the official percentage printed in the law books. What actually matters is the effective tax rate, or the ETR. This is the real-world percentage of profits that a company actually hands over to the government after they've utilized all their tax breaks, all those incentives, and all their strategic planning. And the OECD data on this paints a picture of the ultimate imbalance. They point to this hump-shaped tax burden. Small firms get a few statutory breaks. But mid-sized firms, they get squeezed the hardest. They face the absolute highest effective tax rates because they're big enough to be taxed heavily, but not quite big enough to dodge it. Meanwhile, the frontier multinationals, the largest, most productive firms in the world, often pay the lowest effective rates of all. They have the mobile capital and the highly paid advisors to strategically exploit cross-border tax mismatches and heavily utilize those R&D incentives. And then they just use the capital they didn't pay in taxes to further outinvest their mid-sized competitors. Section 6. Comprehensive tax policy. Okay, we've diagnosed the illness, so what is the cure? The OECD outlines the need for a fully comprehensive, or comprehensive, approach to finally level this playing field. Their solution essentially relies on 5 interconnected pillars. First, simply make the rules easier so young firms aren't immediately buried in compliance costs. Second, target incentives far more narrowly, like make R&D credits refundable for cash-strapped startups. Third, fix those loss offset rules so risk-taking is rewarded symmetrically no matter your size. Fourth, aggressively crack down on that corporate tax planning by multinationals. And fifth, align corporate taxes with broader systems so that entrepreneurs are making actual business decisions, not just tax arbitrage decisions. I really want to highlight this powerful takeaway directly from the source material because it hits the nail on the head. Tax avoidance acts as an inefficient government subsidy to avoiding firms, leading to misallocation of capital and labor. That right there is the core issue. When the tax system allows the absolute biggest firms to pay effectively less than new entrants, we aren't looking at a free market anymore. We're looking at a government-subsidized advantage. And that actively distorts competition and harms overall economic health by trapping capital with the giants, rather than giving it to the true innovators. So, we're left with this vital question to ponder. Will the tax code of the future be designed to genuinely nurture the next generation of startups? Or will it simply protect the giants who are already sitting at the top? The decline in business dynamism isn't just some inevitable force of nature. It is actively shaped by policy choices. By understanding this profound impact that corporate income taxation has, we can better advocate for a truly comprehensive system that rewards genuine innovation and risk-taking rather than just rewarding the ability to navigate complexity. Thank you so much for joining me for this explainer. I really hope it helps you see the business world in a whole new light.